Hello and welcome to Compounding Curiosity. I'm your host Kalani and this podcast is all about compounding your curiosity alongside my own through thoughtful interviews with interesting guests. For transcripts and detailed show notes, check out the links in the description. Hopefully you're as keen as me to learn something new, so let's get stuck in. So Jing, thank you for having me. But I think just to orientate listeners who might be new to you and maybe your writing and stuff, could you just give a thumbnail sketch of your life and career up until today?
Sure. So I was born in 1987, so I'm currently 34. Born and raised in Singapore. So I was one of the when I was in university, I kind of decided that I wanted to enter the investment industry as a career, and it was just so happened that was in 2012 when I was in final year in university, and I kind of naively identified two organizations that I really wanted to work for. One would be Berkshire Hathaway, and the other would be the Motley Fool. So maybe just to backtrack just a little bit more. So I kind of got interested in investing when I was about 17 or 18 years old. I was in junior college in Singapore. So that was kind of like a preparatory course for students before they entered university. And I was doing economics as one of my subjects in junior college. And I thought that the theories that were being taught were just weird and wrong. And I wanted to understand more about how people who actually work with money think about money. So I started searching for successful money managers, right? I did not even know like fund management was a term back then. And I came across Warren Buffett and his peers and his mentors and started learning a bit more about them and realized that, hey, what they say seems to make sense. And so I wanted to buy a book that was written by Buffett's mentor, Benjamin Graham, called The Intelligent Investor. So I think most people who are interested in investing would have heard about the book. So back then, smartphones weren't a thing yet. I was at a bookstore and I kind of forgot the name of Buffett's mentor and the name of the book. And I saw this book on the bookshelves that also had Warren Buffett's kind of stamp of approval on it. I bought that, went back home and realized, oh no, got the wrong book, right? That was actually Philip Fisher's Common Stocks and Uncommon Profits, right? And then I did another background search on Philip Fisher and I realized, oh, this guy is the real deal as well. Right. And so I started reading the book and was like, wow, a lot of things that he said made sense, and especially about how the stock market works and all. And so that was my first introduction to like the financial markets. And I was hooked, right? So that was when I was 17 or 18 years old, like I mentioned. And so over the years, I kind of continued being in touch with investing, started reading a lot of different books about investing and so on. And when I was in university, I actually chose engineering as my degree, right? Because I've always also had an interest in the mathematics and the sciences. And I thought that it would be a lot easier to learn about investing on my own as compared to learning about engineering or the sciences on my own, right? So I took up engineering university and started learning about investing on the side. Yeah, but it was really in halfway through my university life that I kind of really decided that I wanted to take up investing as a career. And for some reason, I've always wanted to, like for whatever role I would be in the future for my career, I wanted to be in a role where I could positively impact the lives of people. And so I was very clear that, even though I wanted to be in like the investment industry, I did not want to just join the bank and sell products, right? Or create like lousy or crappy products. And so that kind of led me eventually to naively kind of like select two organizations that I really wanted to work for. One would be Berkshire Hathaway and the other would be the Motley Fool. And the reason for the Motley Fool was because in 2010, I started becoming acquainted with them as a customer. So I was a subscriber to one of their newsletter services in the US. And as a customer, I could feel their sincerity in wanting to meet the mission that they had, which back then was to help the world invest better. Today, I think, is to make the world smarter, happier, and richer, which is also fantastic, right? And so I kind of really admired what the Motley Fool was doing. And so it also happened that in 2012 was my final year in university, and in HQ in the Motley Fool in the US, they started this thing called a blogging network, which was kind of like a platform for people outside of finance to write about investing. And if they liked what you were doing, they would publish the article under your name, and they would also pay you for it, right? And I thought that, as a student, it was a great deal, right? I could do something that I enjoyed and I could get paid for it as well, potentially. And so I started writing for them, and thankfully they liked what I was doing. And so after a few months of that, they invited a bunch of the more interesting writers they found through the blogging network to HQ for like a one-day conference. And I think when the Motley Fool set up the blogging network, they did not expect to attract anybody from outside of the US. But when I was there, I realized that there were people from few other countries as well. So like obviously I came from Singapore, and I think that there was one other gentleman who came from Latin America. I can't remember exactly which country it was now. But yeah, so very interesting bunch of people that gathered there. And when the people at HQ realized I was from Singapore, they were really excited because it just so happened that it was during that time where they were kind of seriously contemplating bringing the Motley Fool brand into Singapore, right? So after the conference, I came back to Singapore and they got me in touch with the team that was bringing the company to Singapore. And so that was how it started. So January 2013 was the day the Motley Fool Singapore launched, and I was on board from the very first day. Yeah, so I was there all the way to October 2019 when the company closed down. And then in November 2019, I started thinking about building my own investment fund because for a long time, actually, one of the goals that I really wanted to have as a career in Singapore was to introduce an investment fund to Singapore. And that investment fund will be a fund that, focuses on long-term business investing. So, looking at stocks as a business and thinking long-term, and also charging fair fees, so basically doing right by the investors. And so when the Motley Fool Singapore closed down, I thought, now is probably a good time as any to launch a fund. Like I won't have the opportunity to do it under the banner of the Motley Fool, but maybe I can try something of my own. And I thought also that it would be because for Compounder Fund, which is the investment fund that I set up, we also had we had bigger goals than just making profits. I thought that it would be a lot easier to accomplish those goals if I had nobody to answer to except for myself and any partner that I would bring on board. And it just so happened that I've known my co-founder Jeremy Chia for many years. We've known each other since we were about 17 or 18 years old. And he became a colleague of mine in the Motley Fool sometime in the middle of 2017. So we left the company together when it closed down. And I talked to him and asked him if he was willing to set up Compounder Fund with me. And I shared the big overarching goals that we want to achieve. So Compounder Fund has 4 key missions. The first is to deliver a superior investment solution, one that focuses on long-term investing in really good businesses. The other would be to have the fund be a vehicle for investor education. We intend to run it very transparently. So what it means is that we'll share all our holdings. We'll talk about our investment thesis very openly and very transparently, so that people can learn from our experiences. And the third thing, pillar of the mission we have for Compounder Fund is to charge fair fees and hopefully stir up conversation among the investment public in Singapore as to what are fairer fee structures. So we can talk a bit about the fee structure later if we want to. And the last thing is that we wanted Compounder Fund to be a vehicle for us as well to be able to give back to society. Because if we launch Compounder Fund, it's going to be a business. And if it's a business, it will mean that for Jeremy and I, we would have the opportunity to amass certain amount of economic wealth if we are fortunate to make this project a success. And if we manage to do so, then we would have more resources to be able to give back. Right. So we put all of that together and we came out with a mission tagline that says, Compounder Fund's mission is to grow your wealth and enrich society. And so we launched Compounder Fund in somewhere in the middle of 2020, and here we are today.
Yeah, it's a great story because I love it because it's especially something that I could see myself doing or wanting to do is your whole story, and it's applicable to a lot of people, I think, as well. There's so many good launching pads from that, but I think we'll come back to your writing later. But maybe just I'd love to hear, when Motley Fool Singapore was sort of winding down and you were looking to start Compounder Fund, what did that actually look like? What was the process? Because I'm guessing you guys had a bit of warning. So what was going on behind the scenes for you guys setting that up? How did that go about?
Sure. So maybe just a bit of a backdrop as well as to what I was doing in the Motley Fool Singapore. In the Motley Fool Singapore in the earlier years, I was in charge of writing investment-related articles covering the local stock market, which was the Singapore market. And, so basically give my analysis and my thoughts about what's happening. And sometime in 2016, the Motley Fool Singapore launched its first investment newsletter. So we would recommend stocks from around the world, not just in Singapore. So by the time the product was closed, and I think we had recommendations from the US, the UK, Malaysia, Hong Kong. Might have missed out on 1 or 2 countries. And of course, Singapore. Yeah. So quite a nice mix of countries in the newsletter that we ran. And so my primary responsibility when we launched the newsletter was to find the investment ideas, manage the investment ideas, and also communicate the investment ideas to our members. So that kind of also gave me very fortunate, that experience gave me a kind of it allowed the public to kind of know who I was and how I thought about investing. Yeah, because at the Motley Fool, we spend a lot of time writing and sharing our thoughts on investing and how to go about building portfolios and so on. So that experience kind of helped helped me to grow in terms of my knowledge, and at the same time also exposed me to the public. So like there was kind of a group of people who kind of knew who I was and what I was doing. And yeah, so I kind of gained the experience, some of the experience necessary with regards to finding investment ideas and finding good investment ideas. Yeah, and I guess the key difference in between the Motley Fool and like building a fund was that with the Motley Fool, we had a lot of support from HQ, right? We had HR support, we had legal support, finance, and so on. But when it came to launching the fund, it was all of a sudden just Jeremy and myself, like two of us, and we came and we have a background that is, I would say, kind of different from a lot of professionals in the financial services industry. So we did not really know, what it took to build a fund. Like, just to give you an example of like how much of a greenhorn we were. I think when you're managing a fund, the investment fund that you're managing and the fund management company that you're managing it under are actually two separate legal entities, right? But at that point in time, when we first started thinking about the project, we had no idea that they were actually two separate legal entities. So we were that new, right, to actually managing a fund. But we were pretty thick-skinned. We went about knocking on many doors, trying to find as much information as possible about what it's like to build a fund and what does it take. What are all the legal documentations necessary? What are service providers that are necessary, and so on. And so we spent many months kind of piecing all of that together. Yeah. It was a very kind of interesting learning process as well. Because I think what I've also realized throughout the whole journey was that there was no repository of knowledge about that, right? And so that was what I think made it difficult. Like the internet is awesome and all, but like if you Google how to set up a fund in Singapore, there isn't much information about that. Yeah, so it was a lot of like just trying to get people to meet us and share our ideas and talk to them to see how some of these elder statesmen in the industry have done it before, or how like professionals have been working in the space for a few years, how do they see it, and like and what their daily lives are, and so on. So we talked to so many people, gathered all the information, put them together, and realized, okay, so this is what we need. And it was also fun because it kind of exposed Jeremy and myself to the life of an entrepreneur. So managing a fund ultimately is a business, right? And because we are launching it ourselves, in the end, it's also an entrepreneurial journey, right? And so there are things like, okay, how should we think about hiring? How should we think about maintaining the culture? And what should we emphasize when we are trying to earn revenue from this business, right? Like, should we try to amass as much AUM as we can from the get-go, or should we be very careful about the types of clients we want to take on, so that this project, even though it may grow slower as a result, but it would have we think a higher chance of a longer lifespan. Yeah, so all of these decisions came into play as we were building the fund.
But yeah, you spoke about your background and sort of the responsibility all of a sudden. But do you think there was any strengths or weaknesses from your background that you gave that other people might not have, or any benefits you saw that you think you could do that other people couldn't? Or
right. So I think a key benefit that I had was, like I mentioned, that public exposure. So people kind of knowing who I was. I think one of the difficulties, especially for investment funds like ours, is that we are legally not allowed to market. We're not allowed to spend any form of marketing dollars. And so that makes, business development difficult, right? But I was very fortunate that I had already that kind of a bit of that public exposure where people kind of knew who I was. And because of my background with the Motley Fool Singapore, so that kind of became a bit of like a launch pad in itself, to where we had a potential group of investors that would be a lot easier for us to attract, as compared to like a completely new group of people who had no idea who you are. You have no background in money management and so on, and how would you be able to run a fund, right? And so because of this experience that I had with the Motley Fool Singapore, and the fact that I had written like more than 2,000 articles by the time the company closed down, right? Like there's this whole body of work that people have seen me put out, and so they kind of had a decent idea of who I was as a person and as an investor. Yeah, so I think that was really, really beneficial. Yeah.
Yeah. So after going from writing at Motley Fool and doing the newsletter and stuff to now managing outside money, can you talk a little bit about like just what it felt like, almost on like an emotional level, just having that risk of managing outside people's money? Like you're the responsible holder of and the guardian of, I guess, how do you find that?
Yes. Yeah. So when we built a compounder fund, we built it in a way where we could invest the way we would as though it was all our own money. Meaning that, we want to invest in a way for compounder fund. So we want to invest for compounder fund in the exact same way that we would our own capital, right? And so that meant, being very honest with our investors in that we are unable to manage for any form of short-term volatility. So that would mean that, the fund could fall 50% if the market declines. And even if the market doesn't decline, the type of stocks we were invested in could also fall 50% or more. And we have no control over that, right? And it also means that, we tell investors, this is exactly how we're doing it, because like focusing on good businesses, right? And letting their business returns drive the return of the portfolio. And kind of not paying attention to what's going on in the macroeconomy or, politics and so on. And that is not something that, and so what it means also is that we will lose a lot of potential investors, right? Because some investors would prefer, perhaps a fund manager who's very much, on top of like what's going on in the macroeconomy and politics and so on, and how it's going to fine tune the portfolio and stuff like that. But that's not what we do, right? So we were very honest about what we could do and what we could not do from the very get-go. And so I think that has, by being very honest, I think we tried, and in fact are also trying to attract the right group of investors for the fund. And so we also want investors who are only keen to invest with money that they do not need for many years. So that's something we also tell our investors that, hey, this project, it's a long-term investing thing. So, if you need money within the next, say, 3 to 5 years or less, then it's best that you do not invest. It's painful, that we cannot take you on as an investor because that would be less business for us. But we think it's the right thing to do, because if you invest short-term money, it may not have a good outcome for you. And that's the last thing we want for the investors that we have. And so I think we put in a lot of effort, from the get-go to try to self-select and also do some screening also in terms of like having the right investors for the fund. And so I think that gave us a lot of, and after doing all of these, it kind of gave us the mental confidence that, there's a very high chance that the group of investors we have are the right investors for the type of project that we're trying to build for. And so that gives us the mental freedom to really invest like the way we would as with our own money, right? And so I think that really helps to minimize a lot of like the emotional fluctuations that I think can happen. And I have to say I'm also somewhat fortunate in the sense that I have not been, so before I started building the fund, and even before I joined the Multifool, I was already investing for my parents and my family, right? So prior to setting up the fund, just before I started up the fund, I had my family's portfolio was running for 9.5 years, nearly 10, right? So I started in October 2010. So after the financial crisis, but even then, from October 2010 to June 2020, which was when I closed down my family's portfolio, there was a lot of ups and downs in the financial markets, right? Every year there were like big events happening and so on. And stock prices have fallen and so on. But it was very rare for me to feel any form of panic or any form of major discomfort when stock prices are falling. So I think I'm quite fortunate in that regard. I do not know why that is the case, right? But it just so happens to be. And so when managing my own family's money, I knew that I was not very easily influenced. My emotions were not very easily stirred by what's happening in the financial markets. And then when with the fund, given that we had put in a lot of effort upfront to select the right group of investors, that gave us also the mental freedom to be able to operate the way that we wanted to, in the long-term investing way that we wanted. Yeah, and so I think when you put these two things together, then there really isn't a lot of emotional stress that I feel from day to day. Yeah.
No, that's cool to hear. And I love that it's almost like a two-way street as well. Like investors are selecting you guys as a fund manager and you guys are almost selecting your clients as well. So it gives you a better chance to succeed in my mind from the start.
Correct. We call it, the importance of having a mutual understanding between our investors and us as the fund managers. Both parties need to understand what each other are trying to do. Yeah.
Yeah. No, exactly. And I think it gets everyone board and aligned. You've mentioned at the start of this podcast, and one thing that interested me when reading about Compounder Fund was the strategy behind your guys' fees. So could you just explain a little about Compounders Fund approaches to fees and how you guys came to this decision? Because it's a bit different.
Sure. So we set up Compounder Fund with the main goal, our mission is to grow your wealth and enrich society. So the main starting point of Compounder Fund was to really be a project that can help enrich the financial health of people that we are fortunate to have come across and we are fortunate enough to have them trust us. And it's basic math that, for a given level of gross return, the lower your fees are, the higher the investor's net return is, right? So it's just basic 1 minus 1 equals 0. It's basic math, right? And so we came up with the idea that, okay, how can we charge the lowest fee possible and at the same time, not shortchange ourselves? Because if we want to be fair to everybody includes both Jeremy and myself, right? So how can we have a fee structure that is fair for both the investors as well as us, right? And so we came up with a fee structure that has both a management fee and performance fee component. So how then can we, incentivizing towards long-term performance and being paid mostly for performance? And so we came up with the idea that, okay, we wanted, and we were very adamant that compounder fund needed to have a management fee. I think there are many schools of thought about what's the fair fee structure to charge and so on. And some people, they believe that, you should only be paid by performance. We were adamant that we needed a management fee component because we are very aware that, or rather we are very self-aware of our limitations and our capabilities. We know for sure that there'll be periods where we would have significant underperformance, which would mean no performance fees. And in such a situation, we think if we do not have a management fee, we may not be in the right mental state to make the right long-term investment decisions for the fund and for our fund's investors. And so we decided that yes, we need to have a management fee, but this management fee needs to be as low as possible, with the purpose of, mainly being there to keep the lights on. It's not going to be something that can earn us the big bucks. The bulk of the money where we could earn from the fund would come from the performance fees, right? So we came up with a structure where we had a management fee and performance fee, and for the management fee, it would decline as our assets under management increases. So there's kind of like a ladder, right? And so at every $50 million mark, our management fee would decline. And so at $200 million mark, that is when we start off with a management fee of 1%. And at the $200 million mark, if we have the fortune to grow to that size, then our management fee would be, depending on the share class, either 0% or 0.2%. Right. And as for the performance fee, again, we wanted the same kind of incentive towards long-term performance. And so our idea was, okay, let's have a hurdle rate that would be a respectable rate of return. And so we came up with 6%. It's not very scientific, and it's 6% because that was what Warren Buffett used for his investment partnerships. And Buffett is one of our investment heroes, so 6% it is. But this 6% is actually compounded, right? And so what happens is we would take when an investor invests in the fund, when the investment is made, the investor can imagine that there will be a 6% compounded line that is drawn, and the value of our fund needs to be above that 6% line in order for us to earn a performance fee. And our performance fee is at the beginning 10% of the excess returns over that hurdle, right? And each time the fund hits a new high in value, that new peak would then be the new base for a new 6% line. So this hurdle keeps increasing over time. And we think that this is what can incentivize or drive us toward sustainable long-term performance. So that's the whole, I think, thought process. And in terms of sharing the fees, in terms of lowering the fees, the idea was that as we started learning more about the whole fund management business and so on, we realized that the cost involved with running a fund is actually does not increase much over time. The growth in the expenses is actually pretty gradual and slow. And so what this means is that as the fund's assets under management increases, there's a lot of operating leverage that can happen in the business itself. But what this means also is that, there's more opportunity for us to share the spoils with our investors. This goes back all the way to what I said earlier, that the whole purpose for setting up the fund was for it to be a vehicle to help people grow their wealth. And the lower the fees that we can charge, the higher our fund's investors' net returns would be, right? So that we realized that, okay, there's actually a way for us to, lower our fees as we go along. Yeah. So both the management fee and the performance fee declines as our assets under management increases according to that, that kind of a ladder structure. Yeah.
Yeah, no, because for me, it's totally interesting because I've spent a little bit of time in a fund and same sort of thing. You realize, you got to have money to make money. And it just, once you get past a certain point, then it's so much easier. In terms of starting a fund though, what's been the hardest thing that you didn't expect? Was it just all the business operations side of it, or having to wear 7 different hats, whether it be HR, accounting? Like how much did it differ from what you expected?
So like I said, we spent a few months doing all the homework. So you kind of expected that there will be a lot of what do you call it, administrative and regulatory kind of compliance work that needed to be done for the fund, right? So we kind of went in knowing, okay, this is what we would need to do, and it's not going to be fun, but it's necessary because because we need to make sure that the fund is built in the most proper way possible, to ensure that also it's for our investors' safety, and also to make sure that we are doing everything in the most above board manner as possible, right? And so we went to it knowing that there will be a lot of these kind of administrative and compliance kind of work that needed to be done. But when we started doing it, it was heavier than expected. So I think that was one thing that kind of caught us by a little bit by surprise. But we went ahead, we pressed on anyway, knowing that the project could be potentially very meaningful. And so we thought, let's just continue and get it over the finish line, and we can launch. And interestingly, we kind of expected fundraising to be very difficult when we launched the fund. We know we were not naive. We knew that it was going to be an uphill struggle, and we talked to quite a few people who threw out some numbers for us, and we realized that for every dollar that people promise to invest with you, you'll be very fortunate and lucky if you end up with 10 cents or 30 cents, right? So yeah, so it's like 10% or 30% success rate. But what was very surprising for Jeremy and myself was that when on the first day we launched, the initial amount that were promised to us, we had like an 80% success rate. And that was such a nice surprise for us. And we are so grateful, that we had all these people who really believed in what we were trying to do, and who said and who came through, like said that I will be investing, and they really did. And that 80% kind of like success rate thing was like the biggest surprise for us, but in a very positive way.
Yeah, like for me even as well, I've heard from similar investors as well that they'd be stoked if they get 15-20% from promises that they get from even friends and family and people they've known for years. So if 80%, that's huge, but I think that speaks to probably the people you pick as well, I guess. In terms of someone thinking about starting their own fund, is there anything that you'd recommend that they don't do, or some easy traps to look out for, do you think?
Okay, so yes, in terms of what they should not do, I think they really will need to question their intentions for doing this. I think it's really important that, the intention isn't just to a lot of money, because if so, then I think especially in the initial stages, it's going to be very difficult, and it's not going to be, and I think it's going to be very difficult in terms of giving that project longevity. Burnout is going to happen. And especially, if you don't have a passion for it, it may not be easy to handle the emotional fluctuations that could happen, when markets are in a state of upheaval from time to time, as we all know that will happen. Yeah, and so I think it's for anyone who wants to keep their sanity, I think it's really important that they enter. If they are really interested in this, they should question their true intentions as to why they're doing so. I mean, of course, the money part is important, right? No one will ever deny that. The economics of it aren't attractive. But I think personally, there has to be even more important underlying reasons for it. Yeah, for somebody who wants to do this. I think an easy trap, to fall under would be to kind of start off with a very high cost structure, right? So like, if from the get-go you have a swanky office space, you have, a lot of Bloomberg terminals, you have this massive research team and so on. If you're going to do that, chances are that, if one or two, so typically people who build startups like this, from what I've heard, they tend to have one or two very strong backers. But the danger is that if they pull out, then all of a sudden you're saddled with this very high cost structure that is very difficult to unravel, and you're in a dilemma now. Like, should I continue and yet have this huge albatross around my neck, or should I just cancel this whole project, and I may have this other small sum of money that people have said that they want to invest, but I can't really go ahead with it now because that large backer has decided to pull out at the very last minute. And I've heard of stories of such cases actually happening. It's painful to hear, right? And so I think it's important. I think cost as low as possible, even from day one.
To go back to your writing days, and you still write now at The Good Investor, what did your writing process look like when you were writing full time? And then how does that compare to what your writing process looks like now?
Right. So I think back then at the Motley Fool Singapore, we also did a lot of, I think time was of the essence. That's how I describe it, meaning that because even though we were in the business of selling investment advice, but how we kind of gained the customer's attention was also to write about very timely topics. Right. So for example, if like say a very prominent local company had some huge scandal or some huge business development, be it positive or a negative one, then we would try to be one of the very first few organizations to be writing about it and also giving an analytical spin on the topic. Right. And whereas I think for the fund right now, writing for I write not just for the good investors, but even for compounder fund, we do a lot of writing. As I said earlier, one of the key things we want to do for the fund is to be a source for investor education. So that involves a lot of writing, basically explaining how we invest, our investment thesis and so on. But the big difference is that time is not of the essence, meaning that, we can be we can spend as much time as we want writing about our investment thesis and explaining our thoughts as clearly as possible. There's no time constraint, right? Yeah. And also with the Motley Fool Singapore, we spend a lot of time also on investor education. So, kind of writing about the proper mindsets to have with regards to investing in stocks and so on. That's something that we actually also do a lot in the fund. So that's something that's actually similar. Yeah. In terms of the actual process itself, I would say it's similar. It's really just, reading, spend a lot of time reading to see what's interesting and absorbing as much information as we can. And then, if there's anything interesting that we read about, then we can comment on that in the form of an article or a longer form piece and so on. Yeah. So, in terms of the process, it's very similar. One thing that I tried to deliberately do, even today, is that, when I read articles or books or anything written by writers that I really admire and like, I read it consciously, trying to pick up how they construct sentences and how they communicate their thoughts and try to learn as much as possible from the way that they build their article and their sentences.
Yeah, I think that leads perfectly into the next question, which is like, what does your information diet look like? Is there anything you swear by, or what's your reading, listening look like?
So my information diet has changed quite a bit from my Motley Fool days to now. So over the years, there's been a gradual shift. So I think so in the early days, I spent a lot of time looking at the Singapore market, mainly because that was part of what I was supposed to do for my job. And so it was a lot of reading through a lot of company filings. And because we, like I said, time is of the essence. So we spend a lot of time writing as well, right? Whereas now, I spend more time reading than writing. And my information diet, as in I still read a lot of company filings and so on, but now the geographical focus has changed quite a bit, mainly because our fund is global in nature. And I personally have an interest in stocks from not just in Singapore, but from all over the world. So it's really about being, having a lot more time and freedom to be able to read about companies outside of Singapore. So that's one. And over the years, I've discovered very interesting newsletters or communication platforms with very interesting information. So some newsletters, there are a lot of really good Substacks nowadays.
Yeah.
So I think a couple of ones that there's Not Boring by Peggy McCormick. There's one who I think recently migrated off Substack. It's on macroeconomics and modern monetary theory. I think it's run by this writer and economist named Nathan Tankers. Right. I cannot remember the name of his publication. Then there are news sources like The Information, which has really good news about technology companies in the Western world. There's Tech in Asia, which focuses on technology news, but on Asian companies. Yeah, then there's newsletters like Stratechery. I hope I'm pronouncing it correctly. Written by...
Yeah, no, you're right. I think so. Stratechery? Oh, I don't know. I just read it. I never talk about it, so...
It's awesome, right? Written by Ben Thompson. Yeah, and then there's a couple of other Substacks that I kind of forgot, and and lots of people investment legends like Howard Marks. He writes memos every now and then, so that's something that I always keep a lookout for. And I would say maybe in the past 2 years or so, I kind of discovered how useful Twitter can be. I think in Twitter they call it FinTweet, or short, which is short for financial Twitter, right? There's this little corner in Twitter where people who are passionate about investing and people who are professionals in the space, they share their thoughts and all and so on in that platform. And I'm like a lurker. I'm not posting anything, but I'm there and I read what they share and so on. And I find it to have been fascinating over the past few years. Right. Yeah. So so I think the main shift in my information diet over the past, say, 7 years is, one is the geographical focus, the other is the discovery of more interesting publications and the existence of FinTweet. Yeah.
Yeah. Just to quickly touch on geographical focus, do you find any differences because obviously you're more acquainted with Singaporean-based companies, do you find any differences when investing abroad in tech that you might not use day to day or know about?
I think no, I don't think there is a big difference. Of course, because the truth is that, like living in Singapore, we have not really seen the existence of, say, cars made from Tesla, right? Whereas if you're in the US, you're able to see it all the time. But I think, with the internet the way it is today, it's really not so difficult to be able to get information on products or services that you would not be able to see or touch firsthand in Singapore, right? So I don't think it is that difficult. And even then, if I were to invest in a Singapore company, it may be in a company that, say, builds oil rigs or shipyards. And is that something that I, as a consumer or just a lay person, will be able to touch and feel and understand? I don't think so as well. So I don't think geographical constraints, or rather, I don't think geography is a big constraint when it comes to being able to, understand or have a feel of what companies are trying to build or do. I think one of the beautiful things about the internet is that, it has given us the ability, from people from living all across the world, it's given us the ability to really find out as much as we need to, I think, about the companies that we're interested in.
Yeah, no, that's a perfect answer. And yeah, exactly what I was looking for. Because yeah, for me, same thing, back to FinTwit and even the internet, for me, it's just giving me access that I wouldn't get to otherwise. To move into the final round of questions, in terms of undervalued life skills, what do you think university students aren't giving weight to? Like, what do you think is an underrated skill or experience that you think they should have?
Underrated. So that's a really good question. And when you sent the list of questions over, I saw that and it was really good. And but it's not something that I've spent a lot of time thinking about before you asked me this. So I managed to kind of give a little bit of thought about that. And yeah, so I think one underrated, maybe a few, right? My thoughts are also a little bit jumbled. They're not super clear, but I'll try. Yeah, I think there are a few that come to my mind. One would be, I think, the ability or just being very comfortable being alone, right? Having, we humans are social creatures, right? We crave company, crave companionship. Nothing wrong with that at all. But at the same time, it's easy for us. I think easy for people, especially when you're younger, when your hormones are a bit more active, and when you've just become a young adult, right? And you're trying out there to explore the world. And so and I think that at that stage of our lives, people may perhaps tend to crave companionship a little bit more. Could potentially result in people having a higher chance of entering into all kinds of the wrong relationships, right? Be it in terms of romantic ones or platonic ones or business ones, all kinds of relationships, right? And I think that that craving for companionship could result in could make it easier for us to make a lot of poor decisions, I think, if you look back on in hindsight. And, but I'm also not so sure if that's actually a bad thing, because like you say, people learn from mistakes, right? So if I have not made those mistakes, perhaps we would not be who we are today. I see a lot of problems that happen when people are not able to be comfortable, being alone. And by comfortable being alone means like, really being able to love themselves as a human being, right? Yeah. So I think that's perhaps one thing that, it's also a mistake that I've made. Like if I could go back in time, there's something that I would tell myself, right? And one other life skill I think would be to pick up meditation. So it's something that I picked up pretty late in my life. I'm not doing it on a super regular basis, but I kind of started maybe about 4 years ago. And I would say that it has made a big difference in my life because it has helped me develop a sense of, I'm now a lot calmer in terms of my That's just like my day-to-day life. When bad things happen, I'm able to react in a better way. It does not mean that I no longer feel angry or upset or all these negative emotions, but it's just like they come, and I'm much better able to recognize that they are there and just let them fade away and deal with the problem or whatever the situation is in the proper manner. And I credit a lot of that to meditation. And yeah, I think that if more people will be able to pick up meditation when they're younger, then yeah, I think it would be a great benefit to them, especially like, as young adults, you set foot into society, and it's unavoidable that you're going to meet a lot of obstacles and setbacks, right? And sometimes it's painful, it's always painful. But I think, if through meditation, if they're able to handle their emotions in a better way, then I think it would be a net benefit to them. And I hope I'm getting this correct, but I think I remember reading a quote from the Dalai Lama, right, who once said that if we teach all 8 or 9-year-olds meditation today, we can have world peace within 2 generations or something. Yeah, and I thought that was a very interesting quote from him.
No, I completely love that answer. And yeah, just on thoughts on being alone, completely echo that. Because yeah, even for me, I love my friends, don't get me wrong, but doing all this podcasting and FinTech stuff is a big step out. But I think once you're comfortable with it, you can be yourself more freely, I think. So completely echo it. In terms of books, classes, ideas, or experiences, what's been influential in shaping your worldview, do you think, the most?
So I don't think there's been any one single collection of things that has, shaped my worldview. But there are a few, I would say, very interesting books that I've read that have left a very deep impression on me. One would be 2 that I can think of. One would be Guns, Germs, and Steel by Jared Diamond. So it's a book about, why is it that the countries in the European continent ended up being the ones that conquered, the world in the 1800s, 1900s, and so on. And why is it not the people who were living in, say, Australia or the Native Americans who ended up being the ones that, moved out? And according to the book, a lot of it was due to sheer luck because of the way the geography was built. Because in the Asian continent, and so if Europe is actually connected as a landmass to Asia, right? It's very long in terms of its longitude, right? Yeah, so okay, basically it's very wide. Yeah. Latitude, sorry. It's very wide. And what happens is when it's very wide, there are a lot of seasonal variations aren't that drastic when you move from east to west as compared to north to south. When you move from north to south, if you have a continent that's very long in terms of its height, I hope listeners can get what I mean. There's a wide variety of seasonal variations, and what it means is that there's very little knowledge that can be passed on in agricultural societies if you're living in the north versus if you're living in the south, right? Because your climates are just if you're living in the equator versus you're living in the latitude, south, for example, there's just very little knowledge that can be passed on, and so there's very little useful knowledge transfer. Whereas if you are in a continent that's very long in terms of from the direction of east to west, there's a lot more knowledge that can be passed on because seasonal variations are a lot lesser. And so it just so happened that kind of stroke of luck kind of kickstarted a process, kind of a positive cycle that enabled the countries in Europe to be able to become better, more advanced technologically, such that they were eventually able to be the ones that went out to conquer the world. And that left a deep impression on me because that I think spelled out how important the role of luck is to somebody's lives. Right, and not just to an individual's lives, but to like a huge group of people, right? You're talking about like entire tribes, entire nations, right? And it's all because of a stroke of luck as to where their ancestors eventually settled on, right? So also the role of luck, that's one. And the other book that left a big impression on me is *Sapiens* by Yuval Noah Harari. So it's a book that kind of talks about the history of mankind. It's a fascinating book because one of the central ideas is that humans, or rather Homo sapiens, became the most dominant vertebrate species on planet Earth because of its key ability to believe in things that are not grounded in physical reality. So as an example, like our laws, our national boundaries, even in fact paper money, fiat money, these are all ideas that are not grounded in the rules of physics. Right? If you're talking about rules of physics, like the gravity is just a fixed figure. The speed of light is just that fixed figure. There are certain laws that cannot be transcended. They cannot be changed. But none of these physical laws that make up our universe actually say that money has to be this way, or say that national boundaries have to be drawn that way, or says that, commercial law has to be this way. But it's built this way because enough people believe in it. And humans or Homo sapiens' ability to believe in what Harari calls this, I think he calls it the grand illusion or something, is what enables us to be able to be mobilized in a huge way, right? When you can mobilize a huge group of people together because they believe in because they're able to collectively believe in the power of something that is not built upon physical reality. And that's something that's unique to Homo sapiens and not to any other animal species. And I thought that is fascinating. It's something that has stayed with me ever since I've read the book. It has I have not had any kind of practical ideas or thoughts that have emerged from that, but it's something that just keeps coming back to me, and it's just something that fascinates me. Yeah.
No, I think that that's an incredible point, because for me, when you talk about humans' ability to believe, that's been my biggest learning in the past year. Is like you see all of the meme stocks and GameStop and stuff. If enough people believe something is worth it, I don't want to be caught on the wrong side of that. Even if I believe, if enough people believe in it, it is, I guess.
And I guess now that you mentioned this in a kind of somewhat related way, have you ever wondered, what is the actual process by which a stock's price reflects its underlying intrinsic value? I realized that this was a mystery to Benjamin Graham. I believe it was in the 1950s or something, where Graham was testifying in the U.S. courts for some other issue, and one of the lawmakers asked him, like, hey, you're in this job of identifying undervalued stocks, and according to you, stocks will eventually reflect their underlying intrinsic value. And what is the actual physical process that leads to that realization, or that or that leads to the convergence of price and value? And Graham's answer back then was, I don't know, it's a mystery to me. And I thought that was fascinating. I probably came across that 5 or 6 years ago. And to date, I have not come across the actual physical process. I've not learned about the actual physical process as to which price converges with value. I guess is that, there's it's somehow related to, of what you mentioned earlier, that, as long as enough people believe in something, then it can happen. I don't know. Yeah, but
yeah,
it's something that fascinates me.
Yeah, and that's the thing. It definitely makes you think. And if Ben Graham can't come up with an answer, what hope do I have? So
yeah.
My final question for you.
Sure.
What plans or vision do you see yourself for the next 5 or 10 years? What are you most curious about?
So I think there are two parts to the question, right? One is like my long-term goals or the long-term vision I have for myself, and the other would be like what I'm most curious about. So I think for the long-term goal, I'm not really I don't really have visions. I'm more of a process person. So I know that, I want to give Compounded Fund the highest chance possible of being a long-term success. So it's about finding the right processes to make sure that this project can be a long-term success. So it's about putting in place the little things that I need to do every day to give the project the highest chance that it can do well over the long time. So what are these little things, right? So it's like, being disciplined in terms of taking on the right investors, being disciplined in terms of maintaining a low cost structure so that, we can afford to select the right group of investors and not, have to just take any capital that comes into our way. And it's also, being disciplined about the way we invest, making sure that we invest in only the things that we understand and that we know well, and invest basically invest in the way that we know well, right? So these are examples of like the little things that I think we need to do, just showing up every day, to make sure that the fund has the highest chance of becoming a long-term success. And what I'm most curious about, so there are a few things actually. I'm fascinated with how I think cryptocurrencies, or rather, no, I should say blockchain technology, will eventually evolve. There's a lot of, I think I'm kind of sensing a groundswell of excitement about like Ethereum and how it can be like the value layer of what they call Web 3.0, which is like a permissionless, trustless kind of new internet economy. And that is fascinating. And I think if it eventually comes true, then I think somehow it's also perhaps related to like the idea that I mentioned about with the idea that I picked up from Sapiens from Yuval Noah Harari, right? But yeah, that's one area that I'm like really interested to see how that turns out. Another area would be, I think, genomics, right? I think we are perhaps in the cusp of a real genomic revolution. Prices of DNA analysis have fallen tremendously, with the help of companies like Illumina, which my fund owns shares in, just full disclosure. And they've been a key player in terms of bringing down the cost of DNA analysis. And I think that, with COVID-19, it's a tragedy. A lot of people have lost their lives and it's painful. But, one of the positive things that have happened from this global tragedy is that it has, I think, brought people's attention to what is possible with genomics. Because I'm not sure if you're aware, but and I think it was Moderna, when they designed their vaccine for COVID, they did not even have the actual virus in the labs at all. They had what happened was after a research team from China decoded the genetic material from the virus, they kind of blasted it all over the world, and Moderna had the data and they started designing their vaccine. How amazing is that? Like, they could design a vaccine that has worked so well once it has been administered. It's found to have been working so well. And it was designed without even having to see or study the actual virus in the labs, right? And that is, I think, the power of genomics. And I'm just fascinated also by the idea of what can happen, what are the positive implications and also some of the scary implications that can happen to human health and human development with regards to genomics. Because I think there's also a lot of developments with CRISPR editing, which is gene editing using the technology of CRISPR. Yeah, and like designer babies, they may become a thing in the future. And that seems like a scary kind of a scarier type of implication for me. And a positive one would be perhaps one day all of us, when babies are born, they could have their DNA fully analyzed. And then there can be a timetable for them that says that, when you're 15 years old, you should go for these checks because, your genes say that you're perhaps more susceptible to this type of disease and so on. And I think that can have a lot of tremendous positive benefits for human health as well. So genomics is one area that I'm super excited. And then one other area would be, I think, space exploration, right? With SpaceX and Blue Origin. And Jeff Bezos is gonna put himself, I think, one of the first few human tourist flights, right? In a few weeks' time. So yeah, so this is another area that I'm kind of really interested about, because I think I've read articles that says that there are actually asteroids or that hold tremendous amounts of precious natural resources like gold and gas and whatnot. And perhaps one day if you have these asteroids or comets or whatever that orbits the Earth in a regular fashion, and if we can, because of the work of SpaceX or Blue Origin, have reusable rockets, then perhaps we can one day mine those things. And to me that sounds like science fiction, but in a very interesting way.
No, I honestly love your excitement. It's infectious. So I love that answer. That's a great way to wrap up. Thank you, Ser Jing, so much. It's been a pleasure.
No, thanks for having me, Kalani. I've had a really good time.
If you enjoyed this podcast episode, be sure to check out the website compoundingpodcast.com. On the website, you'll find every episode complete with transcripts, show notes, and other related resources. Either way, links to all content mentioned will be in the description below. Also, be sure to sign up for my weekly newsletter, curated by Kalani, where I share what I've been reading, learning, and watching for that week. Same as the podcast, it's compressed to impress, and I aim for maximal return on your time invested. Sign up at kalanis.substack.com. So that's KALANIS.substack.com. You can also connect with me on Twitter at ScarrettKalani. But until next time, have a good one.